Party people, welcome to the absolute greatest investing and trading and life programming on YouTube.
Of all time.
YouTube, yeah, I mean, YouTube, they haven't called us. They haven't been like, wow, what you guys are doing is amazing. So we can't go by that.
Josh,
we just go
one
by...
day.
No, but we just go by the fans. And you guys are showing up every week live, and you're watching the replay, and we love you. So thank you guys so much for being into what we do. I'm here. Let me just take a step back for 1 second. We're going to get into some earnings stuff. We have a whole lot to cover tonight. My name is Downtown Josh Brown. For those of you tuning in for the first time, I'm here with the co-host of the show, Michael Batnick, as always. Michael, say hello to the folks.
Hello, folks. I'm just noticing your name today. It's quite funny.
Yeah, how about
Clever.
that? Hey, let's do a couple of quick hellos. We haven't done that in a few weeks. Tom Whalen, Rita B, what's happening? Akbar Muhammad, hello. Melissa, how are you? James Sykes, Jay Luther, Scott, Bernard Josephs, Gary Walter. We appreciate all of you. I can't do everyone, but we appreciate all of you. Thank you guys so much for coming out. Tonight's show is sponsored by Rocket Money. Michael, what's Rocket Money?
Wait, before we get to Rocket Money, and we will, do you notice anything different? Not about me per se, but about the situation.
What
Dude,
situation?
It's light out.
Oh, is that sunlight illuminating your head?
It's still light. I mean, that's a computer screen mostly, but you see the background.
Yeah, we're getting there.
We're turning the corner. Remember, we're going to see Bud soon.
I heard birds chirping. I heard birds chirping in town on Sunday. It's pretty exciting.
We are so back. It's not even funny.
Back.
All right, so Rocket Money. I mean, we spoke. You know who they are. It's great. It's our personal finance app that allows you to cancel your unwanted subscriptions and monitors your spendings. It helps you lower your bills. You know what I need? What subscription I need to cancel? It's not a subscription. I need to cancel my Schwab account. We'll get to that later in the show. You could cancel stuff right inside of Rocket Money. Like, you don't need to go to other thing. It's amazing.
That's crazy how they could do that,
dude.
That you don't have to go to each of these sites. If you see 3 things that you don't want to pay anymore, right in the Rocket Money app, you can get out of it.
I found out that I had 2 New York Times subscriptions. I don't even know why.
It's dope. I
get these large transactions detected every time Robin makes a large swipe. I love it.
All right, give us the URL. Give us the URL.
It's rocketmoney.com/compound. That's rocketmoney.com/compound.
All right. I'm not having that much fun today. So my day started triumphantly taking 20% of my NVIDIA position off the table right on the open. And I got out pretty close to 700, honestly. And I was thrilled with myself because I think I'm doing the right thing. I don't know if the stock's going to 1,000 or not. But this is the 3rd time I've taken some NVIDIA off the table. Basically every time it triples, I take more off. So I was like, look how responsible I am. And then I own a little bit of New York Community Bank, which I bought for a trade. Stopped out, down 25%. What a piece of shit. I hope it goes to 0. And then after the close today, Snap down. It's down 30% now. So I got out of that after the close. So basically, my day started off with NVIDIA making me feel like making me feel like I'm James Simons at Renaissance, and my day ended with 2 25% quick losses. I mean, the dollar amounts don't really matter on those latter 2, but so what? I feel like a dick. But one thing is that I don't sit around with these things anymore. In this market environment, goodbye. I don't care. So it could double or go to 0. It wouldn't make a difference. And now I'm going to talk a whole lot of shit about this Evan Spiegel.
Wait, hang on. Before we get to those, I want to join you in let's commiserate. So I'm down $3,600 on my Snap position. That's a lot of fun.
I wish that was me. Okay.
I will be, hold on. I'm not done. I will be selling that at some point tomorrow. But to add insult to injury, Yeah. I sold Enphase Energy yesterday because I don't like to take big losses. The only time I take big losses is like this, when it gaps down 30% overnight. Shame on me. We'll get to that in a second. I sold Enphase Energy yesterday. So I'm down 9%. Fuck this stock, I'm out. Guess what? What's this stock up after hours? Yeah, thanks. Salt in the wound. It's up 10% in the after hours. Right. That's fun. So just the double whammy. You wait,
it's
hold on,
earnings
hang on.
season. It's earnings season.
This is the good stuff. This is why I stay in the game. Sometimes you need a periodic reminder. Oh yeah, this is why most of my money is in index funds. Just keep buying because this shit is hard. And sometimes you do dumb shit, and that's the way it goes.
I also whacked PayPal today. They're going to report later this week.
Me.
I don't trust those people as far as I could throw them either.
I'm hanging on for dear life to that one. All right, let's let's talk about Snap. So Dan Greenhouse tweeted this, and I was sucked in. The stock was looking good. The market knew something. No, they knew nothing.
They knew nothing.
They
were
knew nothing.
selling puts today, and the stock was
moly.
up 4%. The stock HOD'd right before the print. Nobody knows anything.
Look at
nothing.
So why? Look at fool me 8 times. It's not enough. Shame on me.
Wait. Can I say one thing though?
Look at that. No, you can't. Look at this. This is the next day price reaction every time they report earnings. It's a joke. What is wrong with us? We're the dumbest investors ever.
Oh man. So can I say one thing? First
I thought
of
it was
all,
different this time. I thought it was different.
They beat on earnings. Revenue was light and guidance was bad, and that's it. Like you can't have a $30 billion market cap doing $5 billion in revenue a year, no growth, and barely any profit, and a little putz running the company who clearly has no idea what he's doing. Like he should fire himself tonight.
I didn't listen to the Spotify earnings yet, but I was looking at their chart of their free cash flow growth. Credit to them. They got the memo. Everybody got the memo. Evan Spiegel didn't get the memo. You're fired.
He announced layoffs yesterday, and I said on TV today, like I don't know, that doesn't sound great. Going into earnings, announcing layoffs the day before, almost like remember we fired people, guys? Like it's so bad. This is maybe the worst managed large. I don't want to call it a tech stock. The worst managed large communications name or social media name. Like it's not even close.
So who do they blame?
Because Twitter's.
Who do they blame?
They blame the Middle East. I don't know if that's hilarious or offensive. They fucking wrote a letter to shareholders and they said, due to events in the Middle East.
I don't even understand. How big is that?
I don't have no idea. This kid should literally fire himself.
Anyway, joke's on us.
Well, not for long. Okay. Do we Chipotle? Do we care? I don't care.
Chipotle just keeps winning. The stock is now, it's a $70 billion market cap almost, or maybe more after hours.
Yeah.
Just a monster. Just an absolute monster.
It's a beast. And the negative on Chipotle was, well, they're not going to be able to raise prices every year. Maybe they will.
Oh yeah. Remember in 2014 when not Einhorn, I think it was Ackman, maybe it was Einhorn, calling it expensive Taco Bell?
Yeah, good call. Hey, you know what Chipotle never did? Blame the Middle East for a revenue shortfall. This kid's out of his mind. This is what they're saying to shareholders? The Middle East? Why don't you just say the dog ate your earnings report? That's insane behavior.
Yeah, you know what? I'm taking my 300 shares and I am leaving, sir.
I bet you he has. I bet you he has all the voting. I bet you there's a. I'm not going to look because I'm out. I bet you there's a dual voting class structure, and he has all the votes. Like I bet you can't even activist this thing. Without even looking at it, I would just make that bet. That's
there's not multiple share classes, but he might have.
No, he might have some super voting stock that doesn't trade. Is my point.
Yeah. Who knows?
And there are a lot of those out there, but he has not earned that. One last joke. One last really funny thing. In 2018, which I think is based on 2017 after they came public, the compensation for that year, they announced it in 2018 for him. I think he paid himself $680 million that year. Well, this company has never earned money.
The stock-based comp is completely out of control, but whatever.
All right, what are we doing? Is it me?
You really sound like Cousine on that one.
Oh, Mike Wilson. All right. So I don't do this stuff where somebody's going through the worst time in their career and you pile on. I just think it's instructive what happened here, and without getting personal about it, I think it's definitely a market story, and I'm going to get into why in a second. But let's just relay the news via Bloomberg. Mike Wilson, Morgan Stanley's top U.S. strategist, is stepping down from his role as chair of the firm's Global Investment Committee. The Wall Street Giants' top-rated U.S. equity strategist will step off the GIC, quote, to focus on serving his key institutional clients where the demand for generating tactical alpha is intensifying, said the COO of Morgan Stanley Wealth Management. So they're going to put in Lisa Shallot to replace him. And they kind of said over the last 10 years, he's been great, blah, blah, blah. So this is my take, and then I want to hear yours. He looked really smart in 2022. And the problem with that, though, is you become synonymous with being bearish if you are the guy who was bearish in a bear market. And you kind of like that attention. And you just like keep letting people repeat that. You called it, you called it, you called it. And he never really was able to shed that persona in the media. He kind of pulled back from doing mainstream media. You only really saw him on Dan Nathan's podcast. And he made like a Bloomberg appearance the day before he got fired. The day before he stepped down. He was supposed to be on our show in October, and he blew us off. And he blew us off in the absolute worst, most insulting way. He went into Google Calendar and removed himself from the calendar invite. This is true. I didn't say anything. I was like, all right, guy's busy, whatever. And then like a week later, he was on Dan's show because they love all that bearish shit. And I just think he didn't want to like defend the bear case last October because the market was like, up on the year. I don't know, or he hates me. Either way. But look, it would be poetic if that was the top. So when did that happen? For the record, last Friday.
Yeah.
It was last Friday?
It sure would be.
All right, what are your thoughts?
All right. My takeaway from this is very simple. If you are bullish in a bear market, your job is probably okay, right? Because everybody's getting screwed in a bear market.
Right.
If you are bearish in a bull market, you are fired. You are out of a job eventually. We've seen that play out a million times. You call it career risk. It's asymmetric. You can be bullish in a bear market and survive. You cannot be bearish in a bull market and keep your job for very long.
So let me add.
Wait, you know why? Because it's like everybody else is making money. You idiot. We got left behind.
100%. And it's Morgan Stanley. So it's like $3 trillion in wealth management assets. And it's the wrong firm to be like the most noted bear on the street for more than 1 or 2 years.
Well, we heard from their earnings report, and I don't know if this is coming down from him or whatever, but 22 to 23% of client portfolios on average was in cash.
That's sick.
And that's a lot of money.
In Mike Wilson's defense, I don't know a single financial advisor at Morgan Stanley that listens to a word he says. So and I know like 20 of them. So I would tell you that Morgan Stanley wealth managers are not listening to Mike Wilson market opinions and then changing around their client portfolios. None of that is happening. I think we mentioned that, like, just joking around, like, why does Morgan Stanley wealth management or asset management have such high cash positions? Maybe it's because the chief strategist is the biggest bear on Wall Street. I don't really think that's what it is. I do believe the story that he feels he can deliver more value with his insights to hedge funds or institutional investors. They don't need to see him on TV. They don't need to read his comments in Barron's. They want FaceTime with him.
Yeah.
Like, that's like institutional investors, don't need Mike Wilson on television being Mike the Bear. They would much rather meet with him in person. So it is, if he wants to stay in the game and add value, that's probably a great move. This is a very visible post. If you are the chief strategist at the largest firm on Wall Street, which is what Morgan Stanley is now, it's a PR, it's a media role, and he doesn't seem to be having fun in the media part of it. So
another takeaway.
I wish him well there.
Another takeaway for me is that's just a really, really tough gig. It's really difficult.
I couldn't do it. All right, I want to tell you a quick story, and I remember this, and a lot of people, I think, brought this up also as soon as the news broke last week. There was a story in 1999 of the chief investment strategist at Merrill Lynch basically resigning / being asked to leave at pretty much the top of the market, or almost at the top of the market. And it was a guy named Chuck Clow, and he's still around. He's still in business. Maybe he's watching the show right now. But Charles Clow was the chief strategist at Merrill Lynch, which at that time was bigger then than Morgan Stanley is now in terms of like how visible. Like Merrill Lynch was like Coca-Cola for investors. This is, before everyone was doing their own thing online. Merrill Lynch was Merrill Lynch. And this guy had the top equity slot. And I want to read you what he said in January of 1999 after big rally in 97, 98, etc. He said, as 1998 goes out, liquidity rules the financial markets, and central bank policies seem more oriented toward capital support than at any time in history. It goes on, and then he basically says, he talks about bank credit in the U.S. has exploded. There's a boom in loans for securities purchases, all these things that were inflating at the time. And he basically says, we believe this is unsustainable. And he had a bearish outlook for 1999, and that was in January. And then by August 28th, he resigned. So he basically, he was 57 years old. He was telling people to put 55% of their money in bonds, 5% in cash, only 40% in stocks. The NASDAQ doubled, I think, twice during the course of 1999. It was just impossible to have the hedge strategist at Merrill Lynch be bearish. So he left, and of course, the rest is history. The stock market topped, I think, 7 months later in March of... Anyway, they put a new strategist in his place, and her name was Christine Callies, and she got the job in the summer of 2000, just as the NASDAQ had topped out. And Forbes described her as, quote, unbendingly bullish. So she was talking the right language. And remember, Merrill needs the bullish talk because they're doing all these banking deals, doing all these IPOs. You can't have somebody that's bearish in the seat if you want to play. Anyway, she gets fired January of 2002 after 2 horrible years of being wrong, bullish and wrong. And do you know who they put into the slot without looking?
Not Henry Blodgett.
No. Rich Bernstein. That's how Rich got the job. Rich was a value investor. He was not pitching tech stocks inside of the firm. And so Rich got the job in January of 2002, and the rest is history. Anyway, there's a Forbes column talking about this, and I don't know who the columnist is, but they call it the market is the great humiliator.
Yes, it is.
So Mike Wilson in 2002 was untouchable. He was the guy. And then 2022, excuse me. And then 1 year later, it's like you can't even keep your spot because you're just that wrong. And that's unfortunately how this game goes. It's really, really tough to survive.
Listen, we got humiliated in the after hours. It happens. That's part of the game.
Bro, I wake up humiliated. It's fine. Anyway, we wish Mike Wilson the best. And hope he's happier in his new role. Okay, go ahead.
All right, let's talk about the future. So we had Warren Pies on the show on the Compound and Friends last week, and he had this great chart showing what happens after a long period of time, after a year passes without any all-time highs, and then you make one. So this is the average of all of those, I think, 14 previous events. And the trend is clear. It's up and to the right. Of course, this is an average of the 14 paths. This is not what anybody should expect to see in any given year. But when you mash them together, that's what happens. So we had that from Warren Pies. Then we had our friend JC put out some great stuff about a potential rug pull coming. And JC is basically saying that on the bottom is the S&P. Yeah, you see the market going up, the index going up. But we know what's causing it to go up, and there's less and less participation. You have less stocks above the 50-day moving average. You have less stocks above the 200-day moving average. Next chart, please, John. You have less stocks making new 52-week highs, and you can change that to 3-month highs or 6-month highs or whatever. It's less stocks doing that. Jason Gepfert shared an incredible stat. The S&P 500, this is from Sentiment Trader, is within 0.35% of its 3-year high. However, fewer than 40% of stocks are above their 10-day average, fewer than 60% are above their 50-day average, and fewer than 70% are above their 200-day moving average. That's only happened one other time. So it's just, and you see the data, it's not great. It's just a very odd dynamic where it's really, 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 really being driven by narrower and narrower leadership. And then JC says, as a potential catalyst, you've got the dollar, which has been a wrecking ball. So an outsized day on the dollar, which means that the open is lower than the previous closing low, and then it finishes higher than the previous high, which would indicate potentially a rug pull coming. What are your thoughts?
Well, I guess all rug pulls start this way with declining internals, and so I know it's like everyone has their own measure of internals, but they all line up right now. I got into a fight with my friend Jimmy Lebenthal on halftime today, because he was saying participation is broadening, and as evidence, he was looking at a few non-tech stocks that he owns that are acting well. So I said, what measure do you look at to say that the rally is broadening? Because it's the
objectively
opposite.
not. It's just not. Yeah.
He's like, well, so I guess he was trying to say he thinks it will broaden. All right, okay. Maybe. I hope so. But in reality, the work that Sean and I did before the show, the percentage of stocks above the 50-day moving average came into the year 90%. That's way too hot. Every stock was in a short-term uptrend coming into the year. Now it's 62% and falling, and that's a big difference. That's a very different environment, 90 to 60. 60 is actually healthy. 80 is not healthy. So it's not hot. That the market is in a free fall. Directionally, we're not broadening out. There are less stocks going up. And NVIDIA going into today was up 40% on the year. So that's why the S&P looks like it's rallying. It's not even how about this? It's not even the Magnificent Seven anymore. It's the Magnificent Six. We're losing mag stocks, right?
Tesla's gone.
Yeah. What if Alphabet's gone? Right? That's not making new highs right now after earnings. So we're at Mag 6 and maybe Mag 5 pretty soon.
Now
NVIDIA reports later in February. We'll see.
Let me just say two things for context. Number one, JC's time frame is probably different than most viewers. And I would think, JC said that they're buying puts. So he's buying options. He's
a trader. If you're not a trader, you can't keep up with what he's doing.
His risk is clearly defined. And I would also note that it's not as if, so even though fewer and fewer stocks are in uptrends, it's not as if they're rolling over and the market is only being held up by a few stocks, because the S&P 500 equal weight is less than 4% off its all-time highs. Okay. It's 3.9% off its all-time highs. And the NASDAQ equal weight, the NASDAQ 100 equal weight is 0.9% off its all-time. It's at all-time highs. It's 90 basis points off its all-time highs. So correct. If the QQEW or whatever equal weighted Qs you're looking at, if they were down 9% and the Qs were at an all-time high, yes, I would say, okay, this is not really what you want to see. That's not the case. Again, the equal weighted Qs are 90 basis points off their all-time high. They're at all-time highs too.
One of the things that we talked about with Warren Pies on the Compounded Friends last week was the pattern. The election. I know you don't really believe in patterns per se, but the presidential election cycle, in year 4, the first half, you kind of fall apart in the stock market to some extent. It's not a rout, but the gains in these years historically are toward the back half when the uncertainty of the election starts to go away. I don't think that the market is being affected by election uncertainty right now, so maybe this doesn't matter. But I would just submit, hey man, you got 50% in the NASDAQ last year. You got 100-something% in some of the biggest, most popular stocks. You got 100% out of Apple off the low. What? Yeah. Is it? Are you gonna be okay if we don't make new highs for the rest of the quarter? I feel like everyone should just take a deep breath, because it doesn't have to be rolling over just because it stops going up. Rug pull is though an evocative term.
Well, that's what he does.
Triggering. Do you know what the definition of rug pull is? The the dictionary definition? I know you
no.
know what it is.
No, I don't.
I looked it up. A sudden revelation that completely contradicts the assumptions one has been led to believe, i.e., in cryptocurrencies, a fraud scheme where anonymous founders trick people into investing for a cryptocurrency project, which is then abandoned. That would be an extreme way to describe a correction in the stock market. Rug pull is like the Fed says we're going to cut rates and then they hike them.
So the average intra-year drawdown for the S&P 500 is 14%. We've basically gone straight up. Is it possible that we get a 10% correction from these levels? Yeah, that's always possible.
Probable.
Yeah, it's always possible. So we'll see.
I'm going to do real quick on JC. I'm going to do the JC pre-market like 9 a.m. show on Monday with Straza. I've either never done it or I haven't done it in so long that I forgot, but I'm really excited about it.
It's fun. All right, so this is interesting. You know what? I'm about to rug pull you, the viewer. So, this is from Barclays. No, listen, hear me out. This is a rug pull. NVIDIA valuations, this is from Barclays. NVIDIA valuations fully priced in the AI GPU growth ramp, and we expect demand growth to eventually moderate as we move from training into the inference phase. Rising competition from peers and customers and any LLM monetization issues are likely to temper long-term outlook for GPUs. China restrictions is a lingering risk. Okay, so is it time to sell NVIDIA? Well, guess what? That note that I just read is from their credit research at Barclays. So
that's interesting.
So the equities, they're still bullish. They have a $650 price target. That is from the credit side of it.
That's not bullish. Do you know where the stock trades?
700. I don't know what is it. You just said
that's
that.
Not bullish.
I mean, it's not super bearish. But what I wanted to flag was this. So only 5%. I'm sorry, only 5 customers, only 5 of NVIDIA's customers provided 46% of their revenue last quarter. That's wild. And it's no surprise who it is. It's Microsoft, chart on please. It's Microsoft, Meta, Amazon, Alphabet, Dell, and Super Microcomputers. So Microsoft alone is 15% of their revenue.
What's this thing that the analyst said about the balance sheet?
So he said that NVIDIA's balance sheet is bulletproof. This is the credit guy. And in the wake of its failure
to buy... That sounds good.
No, he just said his only concern is that NVIDIA is too expensive. Its bonds trade tighter to the equivalent treasury yield than Microsoft and Apple.
Right.
And so he's talking about the bonds. He's talking about
the stock is up 42% in the last 23 trading days, which is so nuts.
So throw some of these charts on. So we haven't really seen this before. Where
I don't like charts that look like this.
No, it's just the ascent is just way too steep. And if you go to the next chart, I threw some Bollinger Bands around the weekly candles, and the RSI is off the charts. I mean, this would be. I don't know.
I don't. It's a blow off top.
It's too much. It's too much.
I don't like charts that go vertical like this after rallying for 2 straight years. And then go vertical. That's the end of a move. That's not the beginning. I don't like charts like that. It's not a gap up. It's not earnings related. That's just literally like, holy fucking shit. How do I not own more of this stock?
So Josh, you're right. It's so as you mentioned, it's gone up 42% in the last 23 sessions. It's not as if like there was an earnings gap in there. That's just straight up.
Well,
so I would.
Hearing Meta and Microsoft talking about their AI capex and Apple, that's what did that to the stock. So they didn't have to report earnings. Everyone else reported it for them.
I'm just eyeballing this chart. This thing could go back to whatever, pick a number, 540, and it would still be in a monster uptrend. So 540 again, which is a number that I'm completely making up, but that's 22% down from here, which would be very, 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 very normal.
Yeah, I mean, NVIDIA doesn't always make it as easy as the stock. It doesn't always make it easy as it's been for the last year or two. What did I want to say on this? The 5 customers that how much of the revenue?
Throw that back up. It's 46%. I mean, that's crazy.
46% is coming from these. All right. What I would say is Dan Ives made the point, chart off. Dan Ives made the point with us on Monday. We posted great quarter, guys. And I hadn't really thought about this. He was saying, like, if you're a customer of Microsoft Azure, the cloud, and you're a Fortune 500 company or you're a government entity or something, and you're looking to get access to AI tools, and you're looking to build something with AI, you have to be ready to say yes, because they have so much going on and so much demand that they'll put you to the back of the line. What CTO can go back and report to the CEO or the board like, oh, why isn't our AI strategy being executed right now? Microsoft waitlisted us because I wasn't ready to pull the trigger. So that's part of this mania that's going on with these stocks and this build. They are absolutely building in advance of actual demand showing up. And Dan made the point that like they really haven't had a choice. And I found that to be really interesting. I wonder how long that could last before we start seeing concrete examples of companies boosting profitability or revenue growth via AI, which we're not really seeing yet. So that's a wrinkle.
This sounds like a Grand Rapids hedge. Nvidia has a $1.7 trillion market cap. I don't think you could say that we're closer to the end than the beginning of this AI ramp up period. I think that we're still in the first innings. Has Nvidia discounted 5 years into the future? Maybe it has. We'll find out. But that being said, in the short term, this thing is way overheated. I'm sorry.
Well, one of the reasons why I was okay selling some of it again is because it's now 3.6% of the S&P 500 and rising. It's not as though the collective we don't have exposure to Nvidia. Like, it's now a really big, really important weight in every like major fund. It's a huge S&P weight, huge NASDAQ weight, huge tech weight, huge semi weight. Like
and it's bigger than
really
that. It's bigger than that. If Nvidia goes down 20%, you don't think that Meta's going to follow? Like,
yeah. And honestly, can you honestly expect, even if they have an amazing earnings report at the end of this month, which I hope they do, can you honestly expect them to add another $750 billion in market cap like they just did over the last 90 days? Like it's like getting really wild. Yeah. So I don't like charts that go up for a long period of time and then empire state building.
Yeah, it's not good.
So I mean, I want the stock to work. I want it to keep going up, but I feel very uncomfortable with the rate of ascent.
Correct.
I think that's a fair way to put it. We should keep going.
Yeah.
All right. It's enough NVIDIA for the week. New Dow stocks. So this is interesting. Tommy Kilgore, who's a very good writer at Market Watch, did a whole piece about how it's very likely, in Tommy's opinion, of course, that there will be a Dow rejigger happening this month. And there's a few reasons for that. The main reasons are you've got this breakage of correlation between the S&P 500 and the Dow. Look at the degree to which that correlation had broken down. And I know that that's a moving target. But if you think about it, these two things used to move much more in lockstep than they used to, these two indices. But the other thing is Walmart's got a 3-for-1 split, and that should be the trigger for the change. Walmart's weighting in the Dow, because it's a price-weighted index, when it splits 3-for-1, will materially fall. The index will have to rebalance to account for that. It's a good excuse to make changes that, according to Tommy and others, could be long overdue. So let me just read this. The last time the Dow made a change was August of 2020. They added Salesforce, Amgen, Honeywell. They took out Exxon, Pfizer, Raytheon. So it's interesting, like, to just think about, well, what would get added if they wanted to do something now, and what would get pulled out. Tommy points out the fact that there are 4 financials in the Dow currently.
Visa, Amex, Goldman, and JP.
Yeah, one of those is probably superfluous, maybe even 2. I don't know. You have two credit card issuers, 2 banks that are almost identical. It might be overkill. So maybe Goldman would come out, and maybe Visa, or maybe American Express, because Visa is more representative of most consumers, and American Express is more toward the high end. I could envision either of those scenarios. Here are the rules for coming in. So it has to be a U.S. based company. So it is. It's not going to be Taiwan Semi. You have to be in the S&P 500, and it should not be part of the transportation or the utility sector. No danger there. And then there are some unwritten rules, and one of them is that they try to keep the ratio of the highest stock price to the lowest stock price at less than 10 to 1. The price of United Health is 22 times the price of Walgreens Boots Alliance right now, for example. So the other thing is, there was a time when companies that didn't pay a dividend wouldn't even be considered, but Boeing doesn't pay one currently, and Salesforce has never paid one, and they're both in. So that appears to not matter. Companies with multiple share classes used to be something that they tried to keep out. I don't think that they care about that anymore, which is why maybe Berkshire could, even though they might have to reduce financials, maybe Berkshire makes more sense as a holding because of how many parts of the economy it touches. The last thing I want to say on this, if you think there's some permanence to these Magnificent Seven names, you don't have enough of them in the index. Do we have a list of the components? Do we make one of those? Here it is. So, I mean, Salesforce is big tech, fine. It's not one of the Mag 7. Apple, okay, that's not going anywhere. But that's pretty much what you have. Like you don't have Microsoft in here, but you have Verizon. You have Cisco.
No. Microsoft's in
Microsoft's in here. Wait, you have Verizon and Cisco in here. I mean, they're not small companies, but you don't have Alphabet or Meta. These are two of the biggest companies on earth. You have Intel. So I wouldn't be surprised if we saw some action. What do you think happens here?
Financials are the biggest sector in the Dow.
Yeah.
21%. It's only 13% of the S&P. By the way,
that's the obvious.
So, John, throw that 3-year chart on. The S&P and the Dow, for all their differences, I don't care, dude. It's the same thing. It still is. It always has been and always will be.
It ends up in the same place, but there could be long stretches where
they
tech
diverge.
is the swing factor.
They diverge. All right, so here's some notes that I took. Goldman Sachs could easily be replaced with Berkshire. They're about the same price.
Yeah.
Cisco is the 27th largest stock, so it really doesn't move the index. Same thing with Intel. It's the 28th. So you could whack those and replace. I mean, Amazon and IBM are roughly the same share price. Amazon is obviously so much more representative of the overall U.S. economy than IBM right now. It's a joke. Coca-Cola. What about replacing Coca-Cola with Pepsi? Doesn't Pepsi do so much more?
Or neither, because you have Walmart, and that's where they're selling this shit.
Anyway, IBM, Intel, and Cisco, what are we doing? We can't do better than that?
We can definitely. IBM is almost like a non sequitur. What's interesting is this is not mathematical. It's a committee, and they meet all the time. Howard Silverblatt is like the chairman of this committee.
What do you mean it's not mathematical?
This is not quantitative. This is pure qualitative.
Well, it's quantitative a little bit in the sense that you want to make sure what's coming out is replaced with a stock with a similar share price, which sounds really dumb, but that's the way that this thing is weighted.
Right. So remember when Apple did a 7-for-1? That was probably because they got the call.
They got them in.
It was like an $800 stock, and they got the call. We're considering you for the Dow 30. When you get that call, you split your stock.
Well, didn't Google split their stock? Didn't Google do the same thing?
They have done that, and they have not gotten in. Here, this is interesting. So I told you the last changes were in 2020, which is now 4 years ago. The last time prior to this that they've waited more than 3 years to make any changes was from June 2009 to September of 2012. Was anything going on then?
Nothing.
We might have gotten a bit distracted in 2009. So they don't normally go this long without a change. So it'll be really interesting. I mean, I could make the case for Meta. And I know, like, oh, it's Zuckerberg, blah, blah, blah. He's like 40 years old.
Amazon, Meta, and Google are not in the Dow. It's a little weird in 2024.
It's a little weird considering how important they are to the consumer economy, the business economy, advertising. They're global. One of them should be in, and it's pretty easy to find stocks that should be out.
All right, let's keep it moving. So Dan Primack tweeted, one thing this job report highlights is how the conversation on X, I'll call it Twitter, over-indexes for media and tech news. So last week we saw a monster jobs report. And yeah, we see Snap, we see Google, we see Meta, and we over-index for what's actually going on. Neil Dutta has this amazing chart showing that the rise in layoffs is not about an economic slump. So he breaks it down between economic conditions, which you saw a lot early last year, of course, a demand downturn, restructuring and cost cutting. And this is all about restructuring and cost cutting. And Josh, we spoke last week on what are your thoughts? Buco Capital tweeted something about we already did the layoff thing. About how companies got to profitability. Now they're moving out. It's the same thing, but now they're calling it restructuring and cost cutting.
Yeah,
more right-sizing the ship.
And they're all like DocuSign just announced layoffs today. Estee Lauder, like it's every day, and we're not in a recession. And again, we still haven't really gotten to the point where these numbers show up in the non-farm payrolls report. They're not showing up. It's crazy, but that's the over-indexing part. These are big, highly visible brands. We all know the name, like Snapchat's layoffs.
Was it 500
yesterday.
people? Was it 500 people at Snap?
Yeah, it's nothing.
Yeah.
It's nothing. It's 500 people. There probably 500 people got hired since we started doing the show in other parts of the economy. So we see these layoff announcements. They're companies we've heard of, and therefore we think like this is this huge phenomenon. It's not yet. It could be. It's not yet. I think you're going to see a lot of finance layoffs this year, personally. So bonus season is now, and I think the restructuring in asset management, private equity, they're just overly staffed, and we haven't really seen that yet because we haven't had a real recession. Normally, you get these financial layoffs during a recession or after. If we're not going to have one, a lot of these companies are probably looking around and they're like, did we really need to hire this many, I don't know, accountants, wholesalers, whatever? So I think you're going to see like pockets, and it's just going to go on all year. It's not showing up in the national data, which is interesting. All right, let's keep going. The consumer. So I guess this is like related to that. Bloomberg Markets Live does a pulse survey. I know you're not a big survey guy, but let's assume Bloomberg is talking to a decent like caliber of household where people actually know what's going on. 463 respondents, more than half said spending will stay strong or get even stronger in 2024, and they told them that they will keep spending on things like airline tickets, restaurant meals, and concerts, which is basically the whole economy now outside of GPU chips. This chart is basically showing that 49% are saying, like, we're fine, we're going to keep going. 45% say it'll slow down. So if you're confused about, the state of the economy, so are the consumers. It's kind of a mixed bag.
Well, this tells you nothing about the future, but it tells you a lot about today. People are fine.
Feel today.
People are fine. People are fine.
Next chart. Economists anticipate the annualized pace of slowing spending will slow this year. So you can see the blue is the estimated growth, which they think drops down. In the fourth quarter, it was about 3%, and they have that dropping down by Q2 to under 1%. And that's just the pace of consumer spending growth. Next chart. All right, this is something worth keeping an eye on. Consumer credit stress to inch higher. Maybe. In 2024, consumer delinquencies and defaults, 76% of people who responded to the survey, which was between January 29th and February 2nd, said that consumer delinquencies will creep higher. That's overwhelming. people expect to see that. Probably not about themselves, but about their neighbors. So this is, I think this is like a really good description of the way things are right now. And that dread that everyone seems to feel is not being alleviated by higher stock prices. Like, it's just with us. People think the wheels are about to fall off still. Like, people just have that foreboding in the back of their minds. What are your thoughts?
Always.
Well, I don't know. I think more than ever, to be honest with you. Like, I don't ever remember a time where you've printed new all-time highs in the stock market and you've had this much dread about what the year could bring.
Yeah. Well, you also never had 30% inflation over a 24-month period either.
Yes.
I'm saying with stocks at all-time highs in our lifetime. That's never happened either.
Do you think that this is going to be one of the more important data points to follow this year, now that the Fed is like not the main thing, or when they cut is now the main thing versus will they keep hiking? I think delinquencies.
What data points? What data? Delinquencies.
Credit card charge-offs, delinquencies, auto loan stuff. Like I feel like this is coming back.
There's nothing there. Bank of America just reported. Yeah. Well, there's nothing there yet. Bank of America just reported earnings, and their charge-offs is lower today than it was pre-pandemic. And I'm not saying that's going to be the case forever, but when it happens, we'll talk about it. Absolutely.
It's amazing.
Okay. Let's talk about it. I'm talking about the Apple Vision Pro. We're going to start with two short clips. John, if you please. And for the list.
Yeah, it's
That's like a lot. There's like a lot going on inside of that box.
It's too much assembly. It's not Apple. Steve Jobs would never have shipped that shit. Okay, for the listeners, that was about 20 seconds of the unboxing of a Vision Pro, and I counted about 17 or 18 steps to assemble it out of the box. I don't think Jobs would have shipped something like that.
The magic of the iPhone is you got your thumb, you've got this, you turn your head, the eyes. It's magic from day one. Now, obviously,
the payoff was trash. Like
okay,
like a sub Jurassic Park quality virtual dinosaur. Like that's the payoff. They shouldn't.
We got one more. We got one more video. One more video, John. Please.
I also want to see what's happening in this game, so I can click on Team Stats, and real time they update while you're watching the game. All the games that are being played, whether they're live or archived for the day, are here. Watch game, I could swap it in, or I could add to multi-view. So all of a sudden one pops up that I'm like, oh crap. Like I can watch on the big screen or I can have it here. Let's go to another game. Philadelphia, Denver. Yes, please. Add to multi-view. So now I have three screens, 3 games. We literally have 5 live streams or archive streams of NBA basketball in my face. I'm freaking out already. I'm like, this is incredible. Then, what do you normally do when you're watching sports? I'm messaging my friends in the group text. So that pops in over there. I could be browsing the web here. This is insane.
Thoughts?
Does anyone besides Kevin O'Connor need that?
If
you're doing a basketball podcast and you need the group chat with the other podcasters, you need the advanced stats, and you need 3 different games on 3 different screens. Okay, who else besides KOC
on Sunday?
You need it
on Sunday in 2028. I will be sitting on my couch watching 14 games at once. I can't wait.
Can I introduce you to Red Zone? Because you only have two eyes in your head.
Red Zone? Nah.
Yeah.
No.
What do you
I
mean?
want all the games. I want all of the games.
But
anyway,
you
let's
only-
not go
you
too
only
down the.
could watch. You only can watch one thing at once. I'm bullish on Vision Pro. I have yet to see the thing that makes 90% of people be like, oh, I have to have it.
No,
That's
well, we
not
know,
it. What you just showed me.
We know that version 1 has a very small audience.
Did you read that people are saying if something goes wrong, you have to bring it back to the store? There's like no support for the device. Like, this is why you don't buy the first of anything.
And everyone knows that. Everyone knows. Yeah. I mean, this is really for early adopters and journalists and all that sort of stuff. But I want to talk about the. So I think like most people, I think that this thing is magic. I think it's going to be a new category. This is hardly groundbreaking opinions here.
Here's what they should have shown. Here's what they should have shown. They should have shown me at 6:00 at night in a suit that has makeup on the collar, sweat on my forehead, my tie choking me. I've just done 3 hours of TV/podcasting, had 7 meetings, and pounded myself with carbohydrates all day. I'm wedged into a 3-seater in the middle on Long Island Railroad, and I throw that thing on my face, and I'm like in paradise. Like I'm on the beach, or I'm like so close to a movie screen, I'm almost inside of it, and I just like escape my life for that 40-minute thing. Like that's the ad they should make if you really want to sell these to the middle class. Get out of your own shitty situation for an hour at a time. Just disappear into another place and time. For me, that's what makes this thing a killer device. They're not playing that aspect up.
They're not doing that. At $3,500.
That's the layup, though.
At $3,500, they're not ready for the middle class. All right, so Bank of America has some projections on what this is going to do to the actual business. They're projecting $1.4 billion in revenue this year, which is obviously a drop in the bucket. 3.5 next year.
I need a device that removes me from this world.
By 2028, they're looking at $18 billion in revenue. Margins are not going to be high on this product. They're looking at 20% gross margins. So I think it's going to be. Are you in more dud in terms of the business, just business, dud or real?
They're having trouble, allegedly, and I only know what everyone else knows from reading. They're having trouble convincing the most important apps in the Apple App Store for the phone. They're having trouble convincing these companies to work with them and develop apps for the device.
Yeah, Netflix is not there yet.
No, Netflix said no, and so did YouTube, and that could change. But like, it's a chicken and egg thing. So this is really interesting to me because Apple, we haven't seen Apple struggle this way, and they might not struggle here. It's almost like you go to the developer community, and I don't mean like, hey, write a weather app. I mean like something like Netflix or YouTube, and you say to them, we're really committed to this platform. Therefore, you should commit your resources to making the Netflix app accessible on our. The Netflix has 2 questions to ask. Number one, do we really want to help Apple, considering that we're competing with Apple in other arenas? That's one. Look at what we're paying to the iOS, to the operating system, to be included in the store. Number 2 is, do we want to spend the resources that it would take to build this thing? What if the product's a flop? And everyone has to make that calculation.
Well, dude, nobody's there yet.
Strategically and financially.
There's no users. They don't have to make that decision yet.
But this is my point. There never will be users if nobody commits to building apps for it.
Okay, I understand your position. I'm not talking about today or tomorrow. In 2028, will this be a meaningful line item for Apple, or will it not be?
40% chance.
That's fair.
That's what I would say. Less than half.
That's
meaningful, because meaningful is loaded. iPhone is a $200 billion annual business.
I understand.
So
I understand.
Meaningful?
I understand it's not going to be bigger than the iPhone or the services, but is it going to be a meaningful piece of their? Are we going to be talking about it on their earnings call?
Can I say a different? Can I tell you a different question?
Yes.
If Dan Ives is right and the product evolves into being a pair of Ray-Bans, which I suppose technologically will become increasingly possible as time goes on, That has been the history of Apple's different products. So if he's right, at what point do people just start using their phones less and therefore replacing them even more infrequently? If 60% of the things you currently do on the phone, on the screen, will move over to what you're doing on your wearable, is that cannibalizing some demand for phones? So, and I'm not even saying it's a bad idea by Apple, because they might have to do that defensively. They're not going to be the only product in this category. They never are. So they might have no choice. But I could envision a world where the internet moves from being handheld to being all around us, and Apple has to play there.
So you said 40% chance, which is fair, that it's a meaningful line item that we're talking about in earnings.
Or 40% chance that it's not meaningful, and
Okay.
I'll use whichever it ends up being.
What do you think are the odds in percentage terms? What are the chances that in 5 years it doesn't even exist anymore because it was that big of a flop?
10% chance. Very, very small.
Okay.
Very, very small.
I'm with you there.
So,
right.
because they really haven't given up on hardware. They've fixed whatever their issues were with original iPad, original watch. They have eventually figured it out. So it's not a slam dunk that they will figure it out, but I also don't think it's a high probability.
All right. My opinion is that this is going to change everything.
Okay, I'm open to that. Let's take everybody out. I want to make the case on Disney, which, funny enough, you own and I don't. I love
Out of here, both of you.
Disney fans.
Ooh, biggest Disney fan. Go ahead.
Those kids are way too cute for you to be the dad. All right. Disney traded really well into the close today. This might be stale if you're listening to this on Wednesday morning, because they report morning or afternoon.
Ooh, go ahead.
I forgot. Either way, they report tomorrow. And
Morning, right? Because isn't Iger usually on in the morning?
I feel like it's always in the morning, but I
think
could
so
be
too.
wrong.
I think so too.
Let's put this chart up. Like, this is what I mean. This is so textbook.
Oh yeah,
Look
well
at-
Snap looked good too. So fuck me. Right?
No. This bounce off the 200 day. And let's not equate this with Snap. It's not overbought yet either. Like, it's not like egregiously rallying. It's just like rallying.
Well, I bought more Disney at the close, so I hope you're right. Go on.
All right. I'm proud of you. I hope this works. I'm not in it. I kind of feel like I should have bought it. I spent some time last night with Professor Jeff Sonnenfeld.
That was great, by the way.
Yeah. Oh, thank you. His look at his office, dude. How out of central casting is that?
Yeah.
That's the Yale University School of Management professor, and he is awesome.
I love it.
He went nuts. He snapped last night, dude. He like went nuts, like all the whole Nelson Peltz thing. He's a big fan of Bob Iger, and he thinks the turnaround is already underway. And Disney has incredible things. So I asked him, then what is this guy Peltz doing? He's like, he just wants to grab a seat on the board and ride the coattails and claim that he helped fix Disney. I said, really? He's like, yeah, that's all this is. And I thought that was interesting. Anyway, let's break down the expectations really quickly. $1.82, $1.82 billion in net income is what the street is looking for. That would be 84 cents. They did 70 cents in the same quarter last year. $23.72 billion, which would only be a 1% gain year over year, the slowest pace of growth since the pre-pandemic period started. Since the pandemic, the post-pandemic period started. I think the expectations are low enough, and Disney's had enough time that they'll find the right levers to pull and be able to make this look like it was a good quarter, no matter what. You don't? I don't
think it's going to trade on this quarter.
Nobody
has big expectations for what they did in the last 3 months. I think more important is going to be what Iger says about the future.
Speaking of breaking news after the close, we're not going to spend a lot of time on this, but we have to touch on it. What was this? What was this thing that came out?
Warner Brothers Discovery, which owns TNT, Disney, which obviously owns ESPN, and Fox, which is, Channel 5 here. It's Fox Sports. They own a lot of football rights. They're going to each own a third of a new sports app that is coming this fall that ostensibly is going to allow people that only pay for cable for sports to opt out of that and get the cheaper version of this. This is a big deal. This is a big
They're
deal.
going to call it like Sports One or something. And so the idea is they now have to compete each individually with Amazon Prime. And that's not really going to be fun to do. So if they all are sharing these games, they pool their resources, they pool their combined audience size, only then can they write checks. The NBA, as an example, is going to want like $70 billion, which would be a triple of the last package. So when they go to TNT, which is owned by Warner, like how is TNT doing that deal? They almost can't do it. So this is a mechanism by which they can all share the costs of keeping these sports rights away from big tech. And it's fascinating. It'll be a lot of fun to watch this play out. So
yeah, and so I guess CBS or Paramount and Universal NBC don't need to be in this deal because nobody pays for those. You get those.
They might have to do their own.
No, I'm saying
They might have to do their own.
That's not part of the cable, but you get that. Just everybody gets channel 2 and 4. You don't need to pay for cable to get that.
No, but they have to pay. CBS has to pay a ton of money to the NCAA to run to run the Sweet 16 and all that stuff. Like, money is changing hands no matter what. So the problem is if it's less ad supported and more subscription supported, and Paramount is not going to be a viable product, CBS is going to have a problem. They have to keep these games. They have the AFC games or whatever they have on Sundays. They have to stay. They have big college sports package. Everyone's going to have to figure out a dance partner because the stakes are just going higher. Live sports is only going up in price. Okay, so that was my make the case. Do you have a mystery chart for me?
So you made the case for stock. Would you consider buying it? Like what?
Yeah, and I don't even care if it goes up after the earnings. I think I'm gonna pull the trigger. I should have done it, and if it drops, I'll probably still buy it. So I think I'm gonna be a Disney shareholder. I think I like the direction things are going right now. So
okay, all right. We're gonna talk about. Let's throw up this chart. This is a weekly chart, and hot dang if that doesn't look like a clean breakout in progress, does it not? Would you agree with that, Josh?
that looks amazing.
This is a very important sector to the overall market and certainly the overall economy. That's for sure.
This is a sector chart.
This is a sector chart. Yep.
I'd like to solve the puzzle.
Okay.
This is XLV.
Yes, it is.
Oh!
It's the third largest. Basically, it's neck and neck with financials.
I did one good thing today.
For the financials and healthcare, the 2 and 3 biggest sectors, second biggest sectors.
I
So
see
it matters.
some people in the chat asking if I addressed Snap. Yeah, I sold it.
If
So
we
now
address Snap,
yeah.
we opened the show with it.
We spent 15 minutes on it at the beginning. I don't know what were you doing?
If you're a moron and you lost 30% at Snap, raise your hand. Oh, yep, that's me.
Yeah,
we did that
I addressed it. All right. Hey, everybody. Did you know tomorrow is Wednesday? Therefore, my very favorite financial podcast of the week, Animal Spirits, starring Michael and Ben, on every podcast app as soon as you wake up. Don't miss that. Ben is doing an all-new Ask the Compound on Thursday. If you have questions, personal finance questions, financial planning questions, tax questions, insurance questions, submit those questions to the Compound, and Ben might pick it and answer it live. And then on Friday, very special guest. We are so excited to be doing the show Friday, and you guys are absolutely going to love it. So look for the Compound and Friends first thing Friday morning. Okay, that's all from us. Have a great night. We'll see you soon.
Good night.